So, is the president's economy in a showdown with itself? It sometimes seems that way. So the question becomes, will strong spending and job growth outdraw weaker areas of the economy? Or will it be the other way around? We'll break it down for you today as we examine the president's economy. The good, the bad, and the unpredictable. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. One of President Trump's signature campaign claims was that as a businessman, he was uniquely qualified to restore the U.S. economy to greatness. So was he right? Naturally, the answer depends on whom you ask. President Trump's Federal Reserve Chairman Jerome Powell recently claimed the economy was, quote, in a good place. By focusing on certain aspects of it, one could certainly make that case. Unemployment, for example, is at a 50-year low, household spending is still strong, and the stock market, despite frequent bouts of volatility, is flirting with record highs. However, as we noted recently on our show about the global economy's synchronized slowdown, the United States has not been immune to impacts from the trade war, and many are increasingly worried about several recession warning signs. Nearly 3 years into his presidency, we feel it's time to take an objective look at President Trump's economic achievements, highlighting the good, the bad, and the, as yet, unpredictable. Joining me will be economist Dr. Art Laffer. He's founder and chairman of Laffer Associates, an institutional economic research and consulting firm. Along with Jeff Small, president of Arbor Financial Services in Melbourne, Florida. He's also the brand ambassador for our very own retirement income store. First, let's focus on some of the positive outcomes of Trump's economic policies. The good. The economy itself has come roaring back to life under the president. The stock market has hit record highs, in fact, record high after record high, helping more Americans build wealth and to secure their futures. That's how the White House summarizes the state of Trump's economy on its website. It's certainly true that his massive tax cuts in late 2017 did kick an economy that had been slowly improving now for about 8 years into high gear. In purely economic terms, the tax bill can be classified as one of the good components of the president's economic policies. Generally, you can say that all of his good economic outcomes really fall into three distinct categories: GDP growth, jobs, and the stock market. The Tax Cuts and Jobs Act had a strong positive impact on all three and is the president's most significant legislative achievement so far. In conjunction with the tax bill, which lowered the corporate tax rate by 15%, the administration also passed several bills repealing Obama-era regulations deemed as being hostile to business, and reduced the Obamacare individual mandate for individual taxpayers. Now, in addition, the administration has also taken numerous steps to reduce banking regulations and to roll back some of the Obama administration's labor policies. In the wake of these changes in the country's annual growth rate, the gross domestic product has generally been strong. Trump proposed consistent growth between 3.5% and 4%, and it has hit that range in 3 out of 5 quarters since the tax cuts and other changes were approved. Now, without question, though, the strongest positive impact of Trump's economic policies has been seen in the job market. In August of this year, the unemployment rate fell to a 50-year low, and, according to the Labor Department, more than 5 million new jobs have been created under Trump, including 400,000 manufacturing jobs. In March of this year, the Council of Economic Advisors reported that 71% of people newly hired in the Trump administration came from outside the labor force. And job growth has continued despite predictions of the contrary. Even many of the president's critics have been surprised by the continued strength of the job market, particularly given how many baby boomers have been retiring in recent years. The administration can also boast record job growth among specific minority groups, namely Hispanics, Asians, and African Americans. Now, in conjunction with job growth, paychecks have also finally started to rise for the first time in more than a decade. The typical American worker's pay is growing more than 3% a year, a level which we've not seen since before the Great Recession. In 2017, a typical middle-class family finally saw their income climb above where it was in 1999, some 18 years earlier. With more Americans working and having more disposable income, it's not surprising that consumer and business confidence have also surged since the president's election, and by many measures, they still remain high. Manufacturing output and business investment saw a noticeable jump in 2018, and there's also been a drop in the number of Americans on food stamps. Obviously, all good stuff. What about the stock market under President Trump? Does that fall into the good category? Ultimately, I guess yes. From the day of Trump's election through January 2018, the stock market soared with the Dow Jones Industrial Average rising by some 7,000 points. It was obvious that Wall Street was very optimistic about these pending tax cuts and their impact, as well as some of the policies of deregulation, and eagerly started pricing that into value in the market even before the legislation itself was passed. Since January of last year, since January of 2018 that is, the market has also managed to attain a couple of more record highs, with the Dow topping just around 27,000 for the first time in its history just this summer. However, that's where the good part of the story ends for the stock market. When we come back, we'll focus on what some see as decidedly bad outcomes of President Trump's economic policies, and later focus on several issues where the jury is still undecided.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Now it's time to bring in economist Dr. Art Laffer. He's the founder and chairman of Laffer Associates, an institutional economic research and consulting firm. Dr. Laffer also served as an advisor to then-candidate Donald Trump back in 2006, and he later published the book Trumponomics, Inside the America First Plan to Get Our Economy Back on Track. Art, thanks for coming back and being a guest of ours right here on the Income Generation.
My pleasure. Thank you for having me.
So, your personal opinion. Let's grade the president. How has he done economically so far in his first 2 years and 10 months or so in office?
Well, very quickly, just go through the 5 pillars of prosperity. On tax side, he's done the best ever. It's the best first term ever. That tax bill that passed in December 22nd on 2017 is fantastic, and it's led to enormous prosperity. On deregulation, he's been the best ever as well. I mean, this is amazing, especially in healthcare, energy. I mean, incredible. On government spending, he hasn't done much. I mean, we need to have a full Congress and president to do something about spending, and that's still a problem. If you look at monetary policy, I think it's okay. I think Jeremy Powell has done pretty well. I know the president bashes him a little bit, and he could probably do a lot better if he followed the president's advice. But trade is the one that's a work in progress. I think the president's doing well. I mean, USMCA is a great deal. I think he's got a great deal coming with Japan. I think if you look at South Korea, there's a good one coming there. But the big one, the big issue is China. And I think they're going to do it in steps. But this could be a barn burner. If he did the right deal with China, that could be an enormous boost to U.S. prosperity and Chinese prosperity. So
Art, would you say that when it comes to this so-called trade war, do we Do we have the upper hand? I know a lot of people I talk to say we do have the upper hand over China because our economy seems to be faring better than theirs throughout this whole ordeal. Would you agree with that?
Well, that's not the way I like to look at it. I mean, I don't think it's the upper hand or not. It's like two guys fighting in the street. If they both fight, they're both going to lose. Now, one may lose more than the other, but this is not an upper hand. We win, they lose, they win, we lose. That's not the way it is. Both of us will win or both of us will lose is the way I look at it. It's the gains from trade, comparative advantage, David Ricardo. Chinese tariffs on U.S. products hurt China. U.S. tariffs on Chinese products hurt the U.S. There's no win, lose, lose, win. It's a gain from trade. And what we're trying to do and what they're trying to do, I hope, is get the other to see that it's a win-win for all parties. And so therefore, I would not view it as a conflict, our upper hand, their lower hand, whatever. I would view it as a win-win for all.
So bottom line, do you feel as though the trade war is really unwinnable? Even if we appear to win on paper, we've still lost essentially?
Yeah, it's not a trade war is the way I would not. Now, I've watched trade wars historically, and everyone loses, and they lose really big. The U.S. stock market, after May of 1930, when the Smoot-Hawley tariff was signed into law, the stock market fell by over 90%, David. That's a bad problem. I mean, it led to the Great Depression. I was in the White House with Nixon. I was George Shultz's right-hand person in the OMB, and when he put on the 10% surcharge, the investment tax credit and all that applied only to American products, devalued the dollar, we had the stock market fall by over 50%. We had the second worst economy since the Great Depression. So it's a lose for everyone if we don't get a good deal with China.
So 30 seconds, what could the president have done differently then other than this so-called trade war?
I'm going to just pull back on that. The president's the negotiator in chief. I really don't understand negotiations. I really shouldn't comment on him because he's done a great job so far in everything on economics. I mean, I can't tell you how wonderful a job he's done on the economy.
Fair enough. Smart man, I wouldn't want to negotiate against the president either. So
no.
We need to take a quick commercial break here, Art, so please stay with us. And you stay with us too. We'll be back here in just a moment, right here on The Income Generation.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit theRetirementIncomeStore.com today to regain control of your retirement.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
While the stock market initially climbed after President Trump's election, it's also important to remember that it had been rising pretty consistently even before that. The Dow Jones Industrial Average basically doubled between the end of the financial crisis and the start of his presidency. Now, if you're a regular viewer, you've heard me point out this rise before and mention that it was due in large part to loose monetary policies initiated by Ben Bernanke and Janet Yellen, who together oversaw 3 rounds of quantitative easing during that time. Now, those policies have continued under Chairman Jerome Powell, but steady stock market growth really has not. From January 21st to February 4th, 2018, the Dow fell by over 2,000 points. And all the other major indices dropped as well. And that ushered in a year of higher volatility for the markets, which culminated with the Dow and S&P 500 both logging their biggest annual losses since the financial crisis. And again, that was in December of last year. Although 2019 has been a bit calmer, the market has experienced several major short-term drops during 2019. And despite hitting 2 new record highs, it remains only slightly higher now than it was in January of last year, 2018. And as I've noted several times on the show, I believe this is a sign that big investors are nervous. They've been keeping one finger on the trigger, ready to pull out when the next major sustained market correction actually hits. So what are they so nervous about? Well, as I noted on our recent show about the global economy's synchronized slowdown, many negative changes, including the stalling stock market, can be traced directly to the president's first announcement about hitting China with trade tariffs. That happened at the World Economic Forum in Davos during, you guessed it, January of 2018. We'll talk more about the trade war issue a bit later, since there are those who still support the policy and feel it will strengthen the U.S. economy in the long run. And that makes it more of an unpredictable element of the president's economy at this point, rather than something definitively good or bad. However, there are some other bad factors that everyday investors should be aware of. For example, after surging for a period following the president's election, both manufacturing activity and business investment began to slow down in late 2018 and then actually began to decline in the second quarter of 2019. The manufacturing index from the U.S. Institute for Supply Management dropped steadily over that same period until it actually contracted in August, then hit a 10-year low in the month of September. GDP growth has also slowed, with the latest figures showing the economy overall expanded by just 2.3% in the last year. And what's more, a majority of economists, as well as the Federal Reserve, Congressional Budget Office, International Monetary Fund, and several other organizations, predict slow growth to remain at about 2% for the foreseeable future. Now, speaking of the Fed again, it's also a bad sign that they not only had to put the brakes on their plans to continue raising short-term interest rates this year, but they actually had to reverse the policy instead. The Fed has lowered rates twice so far this year, currently to a range of 1.75% to 2%, and they've suggested that another decrease is possible. Raising rates, as the Fed did all last year, was a sign it had confidence in the growing economy. But despite this confidence, doing so also ended up partially flattening the yield curve and even fully inverting it for a while, since long-term interest rates were lower than short-term interest rates. Currently, the yield on the 10-year Treasury is actually still below 2%. Now, as I've mentioned often, a flat or inverted yield curve is considered one of the most reliable indicators of a coming recession. There are others out there now, but also several forces in place that some analysts believe could actually prevent another recession. We'll talk more of that coming up in just a moment.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
Now it's time to bring back in economist, good friend of the income generation, Dr. Art Laffer. I want to start by congratulating you and letting our viewers know that you recently were awarded the Presidential Medal of Freedom just in June for your work in economics. So first of all, congratulations on behalf of the income generation.
Thank you. I don't deserve it, but I'm not giving it back.
Humility. I love the humility.
It was really a great honor. I was very honored to get it.
That's right. You'll take the trophy no matter what. So let's talk about monetary policy.
Sure.
You actually made a comment that you think the Fed should probably listen to the president more, although technically the Fed is really supposed to be detached. So what do you think the Fed could be doing better, whether they listen to the president or not?
Well, I don't think the Fed should be detached. It shouldn't be like any other agency, be it an administrative agency, but that's not the way it is. When you look at the Fed, they are not only doing something for the United States, but they live in a world economy. Interest rates are determined on a global scale, not just in the U.S. So we have very low interest rates because the economies of foreign countries are doing very badly. We have low interest rates, inverted yield curves, all of that. Not because of the U.S. We're doing great. So when they look at policies, I think they should consider much more seriously what's happening abroad and therefore should lower rates more than they have already. I think that would be good for the U.S. because, gold prices are way too high. They don't make any sense for the U.S. But if you're in Europe or Asia, they make lots of sense. And gold prices are the same there as they are here. So, I think the Fed should be much more cognizant of the global economy and how well we're doing relative to the rest of the world and how important it is for them to make sure that we're not at a competitive disadvantage with other countries because other countries have lower rates. That's what I'd really like them to do.
But it sounds like you're saying the Fed raised rates maybe too long when they're raising rates and,
Yes.
and too long and too much. But now the question is, what do we do? I mean, if most of the
Lower
world
rates.
turns negative interest rates, should we go negative interest rates? My
Well,
mom
if
always
we
told me, if your friend jumps off a bridge, will you? So should we
No,
go
no,
negative
no.
because they do?
No, you shouldn't go negative because they do. But what happens is our curve, because we have higher rates than the rest of the world, because the Fed has been tighter here and kept the short rate much higher than the rest of the world, if we dropped our rates, we would not have an inverted yield curve. It would be just the reverse. It would make our yield curve much more positive, which is much more prone to economic growth. I mean, banks borrow short-term, they lend long-term. If you've got short-term rates that are way too high, it disturbs the lending market. All of that can be corrected by the Fed if they wanted to, and if they didn't feel pressured to do it, I think they'd do it.
Art, that's what I love about you, the common sense aspect of economics. I had so many economists on here who told me, no, we're not worried about a flat or inverted yield curve because this time it was not because of lack of demand for goods and services, it was because of everything going on abroad. And I said, yeah, but this flat yield curve can be causative, as you said. Banks won't want to land in that environment. So I'd like to just get started in the 30 seconds or so we have left here, asking you about what happened with the liquidity crisis in banks starting on September 16th. I don't believe the excuses I've heard as to why it's happened. Why do you think it's happened in 30 seconds?
I don't think there's a liquidity crisis on banks right now. I just think everything is just fine. I think the banks have stopped trying to reduce their balance sheet and are now into a modest expansion of it again. That's a minor move, I think, either way, and I wouldn't get too worried about that. I think banks are doing just fine. And I think the bank relationships with the rest of the economy are great, and we have a good Fed that will propel us forward. If they listen to the president more, it'll even be better.
If they listen. I don't think they will, but if they do. All right. We're going to take one more commercial break. Stay with us, please. We'll be back in a minute. And you stay with us, too. We have much more here coming up on the income generation. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementinComeStore.com.
When the Fed lowered short-term interest rates for the second time this year in September, Chairman Jerome Powell described the move as insurance against ongoing uncertainty over the trade war. Uncertainty is certainly the most accurate word one could use right now to describe this trade war. And as I noted earlier, many of the indicators of slowing growth in nervous markets can be traced directly to the beginning of the trade war. In fact, it is by far the most unpredictable aspect of Trump's economy, and that's because we're still in the thick of it. From the start, there was little argument about the need for addressing the U.S. trade imbalance and renegotiating some of the past poorly negotiated trade deals. However, Trump's approach to the issue has caused a great deal of argument and has led to major uncertainty. That approach has focused almost entirely on efforts to fix an unbalanced tariff system in which other countries impose larger tariffs on our products than we do on theirs. For almost a year and a half now, the president has imposed new tariffs on imports from many countries, but his main target has been China. China has answered back each time with retaliatory tariffs on U.S. goods, and the ripple effects of this ongoing war have been felt not only here in the U.S. and China, but throughout the global economy. The International Monetary Fund recently warned that the trade war could cost the global economy up to $700 billion before the year 2020 is done, a loss equal to the size of Switzerland's entire economy. The ongoing uncertainty of all this was demonstrated again in mid-October when the stock market spiked based upon President Trump's tweet that a trade deal with China might finally be in the works. The deal has amounted to little so far, though. China agreed in principle to buy more U.S. agricultural products and address intellectual property concerns, and the U.S. agreed to hold off on a scheduled tariff rate hike. However, the deal is still, quote, subject to documentation, close quote, according to Treasury Secretary Steve Mnuchin. And if it isn't finalized, he said another new round of tariffs on Chinese goods will take effect in mid-December. Again, it's still impossible to predict how all of this will play out. But as I noted on another recent show, some pundits are confident that even if the trade war drags on and gets worse, household spending and job growth here in the U.S. might actually remain strong enough to offset impacts of more tariffs. In other words, they believe the U.S. economy is strong enough to avoid a recession because all of the other good impacts of the president's economy, which will outweigh or outdraw, to use the showdown analogy, all the bad and unpredictable. They could be right, but there are other unpredictable issues to consider. One is an incident I also mentioned recently where the banking system experienced an overnight liquidity crunch and which suddenly didn't have enough cash on hand to meet customer demand. As a result, the Fed had to step in and immediately pump cash in the system. They started with $75 billion a day in repurchase agreements for 2 weeks. After that, they announced they would extend the policy through January of next year and also begin buying up Treasury bills at an initial pace of $60 billion. The program will continue into the second quarter of next year, which basically means the Fed is engaged in some sort of quantitative easing to help a troubled area of the economy once again, although the Fed refuses to call it by that name. No one really knows how this banking emergency happened, and that's what's so troubling about it. It feels eerily familiar to 2008 when warning signs about the financial crisis went unheeded until it was too late. We had known back then for months that the subprime mortgage crisis was coming, but we didn't know how the banks had all tied themselves together with these credit default swaps, which meant that simply speaking, when one failed, they all failed. Is this recent liquidity emergency among the banks evidence of something similar? Maybe and maybe not, but I believe it does make the stability of the banking system yet another unpredictable aspect of the current economy.
Would you take your grandchildren out for ice cream and try to pay for it using your stock certificates? No, that would be ridiculous. Instead, you would use your income. So why then do so many retirees make one of the biggest financial mistakes, dipping into their savings instead of relying on income during retirement? The good news? It's completely avoidable. To learn more, visit theretirementincomeStore.com.
All right, time to bring back in just one more time Dr. Art Laffer. Art, thanks for sticking around.
My pleasure. Thank you.
So you mentioned at the beginning spending, that the government could have done more with spending. Talk about that, please. Let us know what you think they could be doing better.
Milton Friedman made the point that government spending is taxation, and it is. Government doesn't create resources, government redistributes resources. So every dollar spent by the government is a dollar taken from someone else, either borrowed or taxed away. That's the truth. So government spending is a huge tax. A country cannot spend itself into prosperity. That's silly. And what we need to do is get spending under control, especially entitlements and those. And the administration and Congress have had no appetite for controlling of spending. There's just no appetite there, and they haven't done it. And that's the biggest shortfall, I think, of this administration and this Congress.
Of course, I have to ask you, the Laffer Curve, something for which you'd become famous, one of the many things, says today, what is the ideal tax rate to get the most revenues for the government?
Well, let me just say the ideal tax rate is not the one that gets the most revenues. That would be one that did a lot of damage to the economy. It has to be way below the most revenues rate, period. So it creates the prosperity, the growth. I mean, you don't want to create unemployment so you have more welfare payments. That's not what you want.
What would
to
that
do.
tax rate be today then that gives that best balance?
You know, I did Jerry Brown's flat tax in 1992, where we got rid of all federal taxes and had two taxes, one on business net sales, value added, and one on personal unadjusted gross income. If you look at both of those two, from the first dollar to the last dollar, and replaced every federal tax, the rate would have been 13% that Jerry ran on, and that would be without any Laffer Curve effect. That would be just that. Can you imagine what this economy would look like with two 13% flat tax rates, one on business net sales and one on personal unadjusted gross income? You don't even have to file a tax return. The companies will pay the taxes and send you the after-tax amount. We'd be to the moon.
So tell me though, can we survive on that today? Has the national debt gotten too far out of control where we can't survive on that? Or can we? Is it too late or not?
It's never too late. We're in fine shape. Well, not in fine shape. I wish the debt were a lot lower. Let me just start with that. But I don't think the debt should be an impediment to doing good economics, and especially at these low interest rates. If you look at debt service as a share of GDP, it's half what it was in 1981. So we can do a lot right now without being terrified of the debt. Now, we want to keep that debt down. Don't get me wrong. Please don't make me say it's not a problem. But right now, debt service as a share of GDP is not a big problem.
It's one thing that helps the low interest rates for sure. We need to leave it there. Dr. Laffer, so much for being on the show. Once again, we really appreciate you.
My pleasure. Thank you very much.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks, but yet you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
Visit theretirementincomeStore.com today to find out how you can rescue your retirement.
I think it's important to acknowledge one other unpredictable aspect of the president's economy, and that's its resilience against politics. So far, the stock market has largely shrugged off the combative impeachment proceedings that are currently unfolding. They also haven't had much impact on consumer confidence or household spending, which remain fairly strong. Will any of that change if the situation in Washington becomes more chaotic? Well, opinions vary, as usual, but the main point for investors in or nearing retirement is to keep in mind that it's another unpredictable factor right now and one of several potential tipping points for the next major sustained stock market correction. And if you're a regular viewer, you know I believe strongly that correction is likely to occur. And that my belief is based not only on all the current warning signs and global economic uncertainty, but on the reliable lessons of market history. The long-term secular bear market cycle that began in 2000 had experienced two major sustained corrections so far. And I believe that history tells us that every secular bear cycle has at least three. While all the Fed's artificial manipulation have managed to delay a third drop So far, I believe the clock is winding down, as evidenced by all the nervous volatility on Wall Street since the beginning of 2018. So, with that in mind, I'd like to reiterate a point that I've been making frequently here on the show, which is that right now we're in a sweet spot for investors who haven't yet reduced their stock market risk by switching from portfolio growth in their focus, to retirement income. Although the market has been volatile and has been trading sideways since early 2018, it still hasn't started that third major sustained market drop that history says has to happen. That means there's still time to reduce your market exposure with minimal loss and avoid getting caught in the next big downdraft. No one knows how much time, of course, but keep in mind the point I made earlier. With the market in a long-term nervous holding pattern, it's a classic sign that big investors have one finger on the trigger, ready to get out as quickly as they can as soon as the next downdrift kicks in. And as I explained before, the situation is a lot like a game of musical chairs. When the music stops and the next big drop hits, whom do you think is most likely to get caught without a chair? Will it be the big institutional investor on Wall Street who has computerized algorithms that can instantly trigger trades on his behalf before the market even opens? Or will it be the everyday investor who still has too much of his savings in risky stocks and mutual funds? Now let's bring in Jeff Small, president of Arbor Financial Services in Melbourne, Florida. Jeff is also brand ambassador of our very own retirement income store, and also has always been a good friend of mine and the income generation. Jeff, thanks so much for being on the show today.
Hey, Dave. Thank you for having me.
Of course. Now you just heard Art Laffer talk about the fact that one of the best things that the president has done that's been successful in helping the economy is the tax changes that he was able to get through at the beginning of his presidency. Would you agree with that?
I couldn't agree with that more. The first politician or president in history to level the playing field with the same corporate tax rate as China. That's an epic thing. He does not get enough credit for that. That's what spurred a lot of growth in the economy, including lots of hiring.
So you kind of went right from the good to the bad, because you heard Art say that the best was really the taxes, and the thing that's perhaps has the worst impact on the economy. He didn't say it was a bad thing long term, but he said the worst for the economy is the trade war. So do you still think we should have handled the trade war this way, in your personal opinion, or do you think perhaps there might have been a better way?
Well, I think there probably would have been a much better way had it been a multilateral front of getting a group of countries together. But the problem is, when you do that, everyone's thinking of their own rice bowl. They're protecting their own economic rice bowl, and they're not worried about anybody else's. So it's really hard to present a unified front. With China being our largest trade partner, and trade surpluses, by the way, at their all-time high, who's getting hurt here? What is the China trade deal really doing? It's hurting sentiment in the market for global growth. That's the factor that it has on the economy and in the markets.
But you think that with the tax cut and the increase in corporate profits resulting from that it gave enough boost to the stock market? Maybe then with some of the money that was given back to individuals through the individual tax cuts, it gave enough to the economy, so that for the most part, Trump was able to engage or create this tax war and play hardball. And so far the economy seems to be withstanding it. Is that your take in the last 40 seconds or so we have in the segment?
Well, it really is. I mean, 75% of the Trump tax cuts went to corporate America. He could have done a little more for the average American. We see anywhere from $1,000 to $1,500 a year of savings for someone that's got $75,000 a year of income based on those tax cuts. He is thinking about, I guess, doing another consumer tax cut next year.
Good. Well, let's see what happens. And of course, we have to see, first of all, how this whole crazy impeachment thing goes in Congress, and hopefully blows right over. And then whether or not he makes it through next November. So we need to take a quick commercial break. When we come back, we'll talk a little bit about the Fed and his influence on the Fed and whether or not it's helpful. You stay with us too. We'll be back here in a minute on the income generation, coming up in just a moment. Now let's bring back for one last segment Jeff Small from Melbourne, Florida, and our very own retirement income store brand ambassador. Jeff, You also heard Art Laffer talk about what's going on right now with monetary policy and the Fed. And he said that the Fed should listen more to the president when those are supposed to be separate. I mean, do you agree with what he said?
Well, yeah, I mean, obviously the Fed made a huge mistake last year in raising rates 3 times, and then they promised 3 more rate increases for 2019 in December of last year. I couldn't agree more. They should have never have raised rates. They made a huge mistake, and now they've got to follow rates because rates are adjusting without the Fed doing anything, and that's why they've dropped rates.
Now, of course, that's great, but if the president has his way, he's already politicianed, if you will, so far to have rates in the negative territory. He says if all these countries essentially don't have to pay any interest on their debt, then why are we still paying interest on our debt? So if he pushes the Fed into negative territory, I mean, is that someplace we should go?
Well, negative rates, people are going to get charged if they have money in banks like CDs and savings accounts. It'll cause people will be stuffing money in the mattress, basically. I think negative rates are used as a last-ditch effort of economic stimulus when there's no real growth in the hope of an economy, much like what they've done in Europe. There's $17 trillion of negative rates, and it hasn't lifted Europe up out of the current economic doldrums that they're in right now.
Okay. Now, I think the Fed realizes they created this flat yield curve that we had during the summertime for a while because they raised short-term rates while long-term rates weren't cooperating and raising ahead of these hikes. So now, to reverse all that, knowing they can't really control the long-term end like they thought they could, and now they're buying back all these treasury bills on a regular basis over the next few months, trying to further shorten or lower the short-term side to righten the yield curve. In your personal opinion, is this too little too late for the U.S. economy, or do you think this can keep the people predicting recession at bay for at least another year or two?
Well, the economy is moderating, and the Fed's trying to plug a hole in the dike and keep the expansion going. This is they're better off doing Operation Twist, what they're doing now, than doing nothing. At least they're trying to make some effort. But we know we're marching to zero because we've got too much debt, potentially negative in 2021, 22. Because we've just got too much debt, we can't afford the interest. The government can no longer afford the interest on that debt. And that's why the European banks, ECB, Bank of England, they've issued all the negative debt. The Bank of Germany, et cetera, has issued negative debt because they can't afford to pay the interest. And we're right there. That's called a Japanese model.
Yeah, and you're right. Japan had it for a few decades now, and it looks like we're going down that path too. So we need to leave it there for today, Jeff. Unfortunately, thanks so much for being on the show. And you stay with us. We'll be right back here in a moment on The Income Generation. I'm David Scranton, and we'll see you in a moment. I'd like to thank both of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. The thing about a showdown is that there can only be one winner. And if President Trump's economy is in a showdown with itself, as I implied at the beginning of the show, it seems like it could be, then at some point a winner must emerge. Will the good aspects of his economic policies, more jobs, higher wages, consumer confidence, will they manage to outdraw the bad, the unpredictable events? Or will slowing growth, mounting debt, the trade war, political turmoil, and other factors prove to be too much for the good to overcome? Well, no one can be sure, of course. However, if you're retired or within 10 years of retirement, is it really worth betting on that first scenario when you really don't have to? Does it make sense to keep investing for growth in the midst of so much uncertainty when the key to increasing your retirement income actually lies in reducing your market risk? Remember, most people agree it doesn't make sense to take big risk unless you have at least as much or more to gain by winning as you have to losing. And that's probably not the case for those who are determined to try to wring out every last penny from today's stock market. As I pointed out before, history does indicate that the next major drop could possibly range somewhere between 45 and 70%. With the market topped out and with it seemingly trading sideways, that means any additional growth is unlikely to be more than 10 or maybe, if we're lucky, 20% at best. In this case, you stand to lose a lot more by taking this risk than you stand to gain. So does it make sense to take that risk? Most people would say no. It would be like going to the casino and playing a game that pays you $10 if you win, but costs you $70 if you lose. Why do that when you can more practically and confidently achieve your retirement goals? How? By reducing your market risk with the help of a qualified financial advisor who specializes in investing for income instead. Thanks for watching. If you're really close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And right here is where you can do it with us on the Income Generation. I'm David Scranton, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.